Along with Brent Cook, Joe Mazumdar is not just teaching investors how to fish, but which fish to throw away. He's an analyst with Exploration Insights. His background is also in geology. Joe, good to have you first time on the show here.
Thank you very much for inviting me.
Well, Brent Cook is very well known in the space, as we all know, and he's been very critical of the mining space. Do you share similar thoughts on the space to Brent?
Yes, in terms of the mining industry, from the companies themselves to the funding and how the entire structure works, yes, it's problematic. I mean, but it's a very good industry with a lot of good people. What we're trying to do is find those companies with the good people in the good times and the bad.
Well, that's my next question. What do you look for when you're selecting a mining stock? What do you know what to choose? And more importantly, how do you know when it's time to, let it go and say goodbye?
Well, I think the first thing you want to do is, always people are the most important part, and then finding out what their objectives are and finding out, is what they're saying going to get them to what they're trying to achieve, and do they have the relevant experience to achieve it? And then you look at the funding. Can they actually fund it? And how would they fund it? And the way Brent looks at companies, we look at a lot of exploration companies and prospect generators where the potential value is obviously uncertain. We don't know what they'll find, but we know that they're good people like Mirasol Resources, who we think have a high probability in a low probability game of finding those projects and attracting joint venture partners. And then also we look at development plays. Can these guys actually execute their plan? Can they get into production? Because right now is a great time to develop, because not very many people are developing. So the people are the number one issue. When do we cut bait,
right,
as Brent would put out, is when they start falling behind in their plans, when we see management movements that seem kind of peculiar. And a lot of it is sort of like The Big Short, in the sense that a lot of people have bought the headline, and really it's about reading the technical reports and reading the financials, which are out there in the public, accessible to everybody, and finding out, hey, on page 32, this just doesn't really make any sense, but nobody's asked that question.
But Joe, what time frame do you give them to kind of, get their things in motion and going? Is it a 1 year, a 2 year? How do you know when to really cut it off?
Well, the thing is, in exploration, we're talking 5 to 10 year time frames, and so they could fail on one project, but they've got a portfolio of assets, but we believe in the team. So that's a long hold, usually, because they might strike it one of these times. A development play is a much shorter term of about 2 to 3 years, where you can see them starting to fall out of scope, where you could see issues with the mine plan, with the development, with them having to constantly raise money because they're underfunded on working capital. So that's a much shorter time frame. But when you get into production, you're riding a cycle. You're looking at how the company's performing, and you will buy and you will sell, within months.
Joe, let me ask you, with the rallying gold price, we'll probably see a lot more mergers and acquisitions. We saw it the last time around, but we also saw a lot of bad acquisitions. So what makes for a good merger? What makes for a good deal?
A good deal is obviously accretive, and then the question is, what does accretive mean on a per share basis? What we've seen in the last cycle is a lot of bad deals, and hence the impairments. Like Barrick just announced that Goldcorp announced $4.9 billion of impairments. They reported another over $2 billion last year, and they're not alone. Barrick's had that, Newmont's had that. They're all divesting assets. The problem with a lot of the M&A for these big companies is that you hit a certain production profile of 3 to 4 million ounces, that it gets very difficult to replete this every year, and you need bigger and bigger deposits to move your needle. But those bigger and bigger deposits are less accretive because they require a lot of capital. The return on investment's very low. And so the growth for growth's sake is not the philosophy. That was the philosophy, but now it's really make money, which means return on investment. Totally different philosophy for companies. And people, to show that, need to reduce their production profile.
Joe, just to wrap, you're a speaker here at the PDAC, the world's largest mining conference taking place in Toronto. What's the one takeaway you want attendees of your presentation to walk away with?
The one thing that we talked about today was just about looking at, we have a lot of risks in mining. One of the risks was financing. but over the last few years, a few companies had been able to raise money. And so what we were trying to do, that even though they raised, they developed the project, they still failed, some of them. So how can we read the tea leaves of the capital structure to look back and say, could this have told something for us in terms of due diligence that we might have recognized that there was an issue here before?
Joe, I like the way you said it. Tea leaves indeed. Thanks so much for joining us here on Kitco News, and thanks for watching our kickoff coverage here at the PDAC in Toronto. We'll have a lot more for you.
Come discover the world's greatest geological potential. Our potential is your opportunity.